There's a number almost nobody calculates for their investments, and once you do, most of the financial debates you've watched for years end in about 30 seconds. The number is your investment's hourly wage, not its total return, not its annual percentage, not its tax efficiency. The actual hourly wage you earned for the hours of your life you spent on it. In this video, I'm going to run that calculation honestly on the most famous debate in personal finance: real estate versus index funds. Two people, same age, same starting capital, same income, same city. One buys a rental property, one buys index funds. We're going to track them for 20 years, exactly like every other video on this topic does. But we're going to add the one column the rest of them leave blank: time. By the end of this, you'll see how much each one of them was actually paid per hour of their life spent on their investment. The number is going to surprise even people who already think they know the answer. I'm Jack. I cover the financial math that gets glossed over in most YouTube finance content. No agenda, just real numbers. If that's the kind of breakdown you want, hit subscribe. New videos every week. Section 1. The number nobody calculates. When most people compare two investments, the metric is total return. Did this asset class give you a higher percentage gain over X years? But that comparison silently assumes your time is free. As if the only resource you spent was money. That's wrong. And it's wrong in a way that systematically favors the loudest, most labor-intensive investments. Real estate gets called the path to wealth because the dollar numbers can be enormous. But once you factor in how many hours of your life went into earning those dollars, the picture often inverts. Let me state it simply. Every investment has a hidden hourly wage. The money you made divided by the hours you spent. That number determines how much of your actual life you traded for those returns. A 10% return that consumed 2,500 hours of management isn't the same as a 10% return that consumed 50 hours of clicking buy and walking away. This is the column finance YouTubers don't show you, because if they did, half the videos on this platform would lose their plot. Today, we're putting it back in. Section 2. Meet Daniel and Theo. Both are 30 years old. Both have $50,000 saved. Both earn $55,000 a year. Same city, same lifestyle, same starting point. The only variable is what they do with that $50,000. Daniel uses his $50,000 as a 20% down payment on a $250,000 rental property, the 3-bedroom in a decent neighborhood. He takes a 30-year mortgage at 7% interest. Monthly mortgage payment, about $1,330. He finds a tenant and locks in $1,800 per month rent. On paper, that's $470 per month in cash flow before expenses. He drives past the house on his way to work and thinks, "I own that." He tells everyone he knows. Theo takes the same $50,000 and puts it into a total stock market index fund. He sets up an automatic $300 monthly contribution and stops thinking about it. When his coworkers ask what he's investing in, he says index funds. They nod politely and change the subject. Nobody is impressed. Here's the first thing every real estate versus stocks video ignores. The psychological experience of these two investments is night and day. Daniel's is visible, tangible, socially impressive. Theo's is invisible, abstract, and boring. That difference will drive every choice both of them make for the next 20 years. Feelings are expensive. Section 3. Year 3. When the spreadsheet meets reality. For year 1, Daniel is living the landlord fantasy. Rent hits the first of every month. He's writing off mortgage interest and depreciation. Equity is building. The neighborhood is appreciating. Everything is working as advertised. By year 3, Daniel has collected $64,800 in rent. His mortgage payments total $47,880. So gross cash flow is $16,920. That's the number on every real estate guru's thumbnail. Here's what the thumbnail never shows. Property taxes, approximately $9,000 over 3 years. Insurance, approximately $4,500. Water heater that died in year 2, $1,200. Roof leak in year 3, $2,800. 1 month of vacancy between tenants. $1,800 in lost rent plus $600 to relist. Daniel manages the property himself to save money, which means late-night calls, weekend showings, and coordinating repairs on his lunch break. None of that time gets reimbursed. Real net cash flow over 3 years, somewhere between $2,000 and $4,000, not $16,920. Now here's where we add the column nobody else adds. Daniel spent, conservatively, about 100 hours in those 3 years on management, tenants, repairs, and paperwork. So his hourly wage on this investment so far is $3,000 net divided by 100 hours equals $30 per hour, less than his hourly rate at his actual job. Meanwhile, Theo put in $50,000 plus $10,800 in monthly contributions. At roughly 10% average annualized return, the long-run total market average, his portfolio is sitting at about $76,000. Time spent over those 3 years. Maybe an hour to open the account, a few quarterly check-ins. Call it 5 hours. Theo's gain over those 3 years, about $15,000. $15,000 divided by 5 hours equals $3,000 per hour. Daniel, $30 per hour. Theo, $3,000 per hour. Now, before any real estate investor types furiously in the comments, this is only year 3. Daniel has a major advantage Theo doesn't: leverage. We're going to keep watching this play out. Section 4. The leverage defense and its real cost. The real estate side's strongest argument, and it is a strong one, is leverage. Daniel used $50,000 to control a $250,000 asset. After 3 years of 3 to 4% appreciation, that property is worth $270,000 to $280,000. His equity has grown to about $55,000 to $65,000. A meaningful portion of that came from using the bank's money, not his own. This is the single biggest mathematical advantage real estate has over stocks. With $50,000 of his own, Daniel benefits from price moves on $250,000. With $50,000 of his own, Theo only benefits from price moves on $50,000, plus his contributions. That 5-to-1 leverage is real. It's why real estate produces a lot of millionaires. But here's the part the leverage argument always leaves out. Leverage doesn't just multiply gains, it multiplies hours. The bigger the leveraged asset, the more management it demands. The bigger the leveraged asset, the bigger the disaster when something goes wrong. The bank fronts you the capital. The hours, those still come out of your life. Leverage is amplification on both sides of the equation, and one of those sides is your time. Section 5, Year 10, where the race looks even. By year 10, Daniel's property is worth $335K to $350K. Remaining mortgage balance, about $166K. Equity, $170K to $184K. Out of pocket beyond the original down payment over 10 years, roughly $20K to $40K. Theo's portfolio, with consistent $300 month contributions, has reached about $165K to $180K. Total contributions, $86,000. The rest is pure compounding. 0 phone calls, 0 weekends fixing anything. At year 10, the headline numbers are close. Net worth from the investment, roughly the same range either way, $170K to $185K each. Now the hours column. Daniel, over 10 years, has spent conservatively 100 to 150 hours per year on this property. Tenant turnover, repairs, paperwork, phone calls, drive-bys, leases, taxes, insurance reviews. Call it 1,200 hours total over the decade, the equivalent of 30 working weeks, 3/4 of a year of full-time work scattered across 10 years. Theo, over 10 years, has spent maybe 30 hours total. Most of it was watching the 2020 crash and not selling. Per hour effective wage on each investment, year 10. Daniel, $155 per hour. Theo, $5,000 per hour. Still close on the headline number. Wildly apart on hourly wage. Section 6, Year 20, the real reveal. By year 20, Daniel's property is worth $450K to $500K. Mortgage is paid off, or nearly so. Equity, $400K to $500K. Theo's portfolio, with the same $300 a month contributions at 10% average return, is at approximately $420K to $460K. Total contributions, $122,000. The remaining $300,000 plus is pure compounding. Headline numbers, nearly tied. Per hour wage on each investment over the full 20 years. Daniel spent roughly 2,500 hours managing his property over 20 years. He cleared about $450,000 in equity, plus modest cash flow. His effective hourly wage from this investment, approximately $180 per hour. Theo spent maybe 50 to 100 hours total on his investment over 20 years. He cleared about $300,000 or more in compounded growth. His effective hourly wage, approximately $3,000 to $6,000 per hour. Same finish line, vastly different hourly wage. But, and this is the part most people miss, those numbers don't tell you which one is better. They tell you what each one cost in life. If Daniel could have earned more than $180 an hour at his day job during those 2,500 hours and invested the extra in index funds, he would have come out further ahead with less stress. If his realistic alternative was earning less than $180 an hour, real estate was the correct call. The hourly wage of an investment is meaningless until you compare it against your alternative use of those hours. That's the question almost nobody asks honestly. Section 7, the compounding bomb, one variable change. Here's the part that quietly settles the math for most people in the audience. If Theo had increased his monthly contribution from $300 to $500, his 20-year portfolio would jump to about $550K to $600K. He just put more dollars in. He didn't put more hours in. If Daniel wanted to add the equivalent firepower to his real estate strategy, he'd need to buy a second property, second mortgage, second tenant, second water heater that will die at 11 p.m. on a Sunday, roughly double the hours. In the stock market, more dollars in just means more compounding. In real estate, more dollars in usually means more hours. That asymmetry is what the hourly wage frame finally reveals. Real estate has a tax that doesn't show up on any spreadsheet. The tax is paid in time. Section 8. When real estate actually wins on per-hour math. Let's be honest about both sides, because if this video only listed real estate's costs, it would be doing exactly what every index fund YouTuber does. Real estate beats stocks on a per-hour basis in specific situations. House hacking. Living in one unit, renting the others. You'd be paying for housing anyway. The hours you spend on the property are partially hours you'd spend at home regardless. Per-hour return can become enormous. Strong rent-to-price markets. In markets where monthly rent is 0.8% or more of the property's purchase price, the cash flow math works in your favor from day one. Most markets in the US and UK don't meet that threshold anymore, but the ones that do are gold. Built systems, if you treat the property as a real business, screening systems, automated rent collection, dedicated contractors, scaled property management, your per-hour return rises dramatically. Most landlords never get there. The ones who do are operating at a different return profile entirely. 1031 exchanges, and depreciation. Tax advantages stock investors literally cannot access. Properly deployed, these can outweigh the per-hour disadvantage entirely. Real estate isn't a bad investment. It's a specific investment that works exceptionally well under specific conditions most people never bother to verify before buying. Stocks have real downsides too, and ignoring them is what the typical passive investing video does. Volatility is real. Watching $150,000 fall to $95,000 in 4 weeks during a crash isn't theoretical, it's gut-wrenching. And data shows most retail investors panic sell during crashes and buy back after recovery, locking in losses at exactly the worst moment. The strategy works perfectly if you hold through everything. Most people don't hold through everything. No cash flow. Index funds don't send you a monthly check. On a total market fund, the dividend yield is around 1.5%. On $150,000 invested, that's about $200 per month. That's not replacing anyone's income. No leverage. Theo used $50,000 to control $50,000 of assets. Daniel used $50,000 to control $250,000 of assets. That asymmetry is real and matters. No depreciation shelter. Real estate investors can legally deduct the theoretical decline of their building's value from taxable income, even when the property is actually appreciating in value. Stocks have no equivalent. So who actually wins? The answer depends on the question almost nobody asks honestly. What is your hour worth? If you have local market knowledge, the temperament for illiquidity and unexpected costs, the time to manage a property, and access to a market where rent-to-price ratios support real cash flow, real estate can build wealth in ways stocks cannot. If you want simplicity, diversification, liquidity, zero management time, and the ability to scale by clicking a button instead of buying a building, index fund investing will build comparable or superior long-term wealth with a fraction of the hours. And if you can run both, owning property in a strong rental market while continuing to invest in index funds, the combination is genuinely the winner. That's a separate video. But the most important question you can ask about any investment isn't which one wins on average. It's this: did I include my time? The answer that includes time is the only answer that actually matters. If this gave you a sharper picture of how these two investments really compare, the actual version, not the thumbnail version, hit subscribe before you go. I make a video like this every week, breaking down the math nobody else shows you. And one question for the comments: what's your hour actually worth? Not your salary. Your real hourly wage when you include everything you've ever traded time for. Drop it below. I read every reply. Thank you for watching.